We're live.
Hello, and thank you for coming back for the Capital Markets Program. We will now have a session on the electrification revolution and the impact of this on the input metals. I would like, for this session, I would like to introduce Stefan Stuart, the CEO of PowerOre and Ore Finders. Steve?
Good afternoon. Thank you, Ran. Hi, everyone. My name is Stefan Stuart. I am, as Ram said, I'm the CEO of PowerOre and Ore Finders Resources. I'm very pleased to be here tonight with a very interesting panel here. Each of these gentlemen are experts in their own right, and each has a different angle on what we're calling, or what I call, the electrification revolution. And I'm really excited. I'm really passionate about what this is. I think it's we're sort of at a paradigm shift in terms of electrification, and what I mean by electrification revolution, it means ultimately we're going to get away from fossil fuels. Now, I don't think that's happening today, but it's happening, and I think it's happening a lot faster than most people realize. We see in the media a lot of talk about Tesla. Also, if you follow the space, you'll see there's a lot of talk about solar power becoming energy cost parity when it comes to production. I think there's still issues when it comes to the storage and usage on demand. But again, we're getting closer and closer as these technologies develop. I think what's important to note, this is not an environmental movement. It might have started off that way, but this has become about economics. And if you want mass adoption, it has to make economic sense. And I think cost parity, and this is something we'll talk about, is going to be the key, and I think we're there. So before I let these gentlemen introduce themselves, I just want to point out one quick thing, what might be of use to you. If you want to get some information on these guys, just send an email to, we got it up there, PDAC@powerore.com, and instantly you'll get their websites, their information, et cetera, et cetera. So that's just a little tool for you guys to utilize. So why don't I get started? Allow these guys to introduce themselves. I'll start immediately to my left. Ted, go ahead.
Hi, thank you, Stephen. So I'm Ted Graham. I'm the head of Open Innovation for General Motors. I work under the premise that we don't have a monopoly on IQ points within our company, and that we need to find outside partners, including your industry, to help us in the world of autonomous, connected, electrified, and shared vehicles. So this is a massive transformation for our business, and my job is to work with these outside partners, including universities, startups, as well as incubators, accelerators.
My name is Anthony Maluski, and I'm the CEO and chairman of Cobalt 27. Several years ago, my partner and I, Justin Cochran, we sat back and looked at the world and realized that we are in a time of great change. Two of the most important industries on Earth, namely the automobile industry and the energy industry, are undergoing significant structural change. 60% of crude is used in automobiles today. And in the automobile industry, you have a moment where, from a base of zero, 5% of new car sales globally in Q4 were EVs. And moving to a world where if you have a child born today, it's likely that they won't even get a driver's license because autonomous vehicles will rule the market. So we wanted to create a proxy in the basic materials space for the adoption of the electric vehicle. That proxy, in our view, is cobalt and nickel. Cobalt 27 represents a streaming and royalty vehicle that is something like a Franco or a Wheaton Precious, only that it allows the investor exposure to cobalt and nickel.
Simon Moores, Managing Director of Benchmark Mineral Intelligence. We set the company up 4 years ago to be a price reporting agency, really to set the lithium price. Now the prices we collect is the lithium industry reference price, but we do cobalt, graphite anode, and we're soon going to do nickel as well. But really, we specialize in the whole supply chain. So our clients, the people we advise, are anyone from the mining side to the chemical processors, to the lithium-ion battery makers, to the car companies. And actually, we're seeing big industries outside of that supply chain come into the market as well now. It's been a mad 4 years. To be honest, it's been a crazy 18 months watching the rise of what we call the battery mega factories, sparked by Tesla's gigafactory, but now we have many more in the pipeline. So I'm looking forward to this discussion today.
Hi, my name's McMurray Whale. I'm an equity analyst and a partner at Cormark Securities. I've been covering stocks there actually in the industry since 2001. Right now, I cover a lot of industrial technology companies, including lithium, cobalt, and graphite companies. And my approach is to take a sort of a technical view of what these companies are trying to achieve. My background, I have a PhD and a master's degree from MIT, where I worked on solar panels and semiconductor processing technology. So I try to take that, that basis and use that to give investors some insight into these companies. And it's been a wild ride. I think I started covering some of these lithium names back in 2007, 2008. When that first sort of wave of tightness in the market came, and it kind of went away for a while. We saw again a big increase in excitement back in 2015, 2016. I think we're in a situation now where the cycles are going to be a lot more narrow for a bunch of reasons we can talk about, but I don't think we're in a situation where we're going to be another 5 or 6 or 7 years before we see tightness and valuations increase again. So thanks for asking me here. I'm looking forward to a great discussion.
I'm Guy Bourassa, President and CEO of Nemaska Lithium, involved in the development of a vertically integrated lithium project here in Canada, province of Quebec. Been involved in that project since the fall of 2009. So we aim to be the first lithium hydroxide with the greenest way of making lithium hydroxide salts in Canada and around the world. And well, definitively look forward to having more discussions on this with you.
Okay, thanks, gentlemen. So I'm going to start with probably the most, while we're all here, is we want to find out how to get exposure, how to make money. So I'm going to start with you, Guy, and I'm going to ask you, and we'll come back down the panel. I probably know the answer to your question, but on a pound-for-pound basis over the next 12 months, what is the best, where are you going to get the best returns on the commodities that are impacted by this electrical revolution?
I think we're going to get that out of lithium, obviously. Well, because the market itself has seen a very sharp decrease in the last 12 months on the price of lithium. I think it's artificial. It's led by misunderstanding of analysts and market in general, dictated by the spot price within the Chinese market for low technical grade carbonate. And it seems to dictate to the market what is supposed to be the price. It does not take into consideration the high-end lithium hydroxide or even carbonate that is used and needed rest of the world, which has not declined. Now we have about 2 or 3 quarterly calls that have been done by the majors, confirming that their outlook for production or demand is higher. The prices are still getting a little bit higher, definitely not declining for the good quality product rest of the world. So I believe that with the next 1 or 2 quarterly calls, market will realize that yes, there is a shortage of good quality product, and that's why I'd say that lithium is the best commodity to look at in the next 12 months.
I would have expected nothing less from you. So
I would agree with that. Largely, it's interesting if you take Simon's curves of demand for all the commodities, and you project that across the cost curve for all the projects that you can find and do a reasonable analysis on, the stock valuations are discounting prices below what you need to have those mines come online. So that's just going to, valuations will fluctuate up and down because of, say, China spot, which doesn't mean anything if you really look at the economics of the majors and the suppliers. It does not translate into the pricing that they get. But even so, right now, the valuations are discounting an unrealistic price. So something's got to give. Maybe the demand curve is not as strong for a bunch of reasons. There could be a recession. There could be anything that happens between then and now until 2025. But along the way, there is going to be tightness. It's going to get looser and tighter, and pricing will fluctuate. But without a doubt, the valuations, whether it's cobalt, you could argue maybe with graphite, but lithium stock valuations are way below what's necessary to support the supply.
I mean, from us, we look at it as a reason we chose 4 battery raw materials from a fundamental basic principle. You've got lithium, graphite, cobalt, nickel. Now, the materials that are used in batteries are not commodities, they're specialities, speciality chemicals, speciality engineered minerals. So that middle step to turn that material into a battery-grade, consistent product that car companies, or battery companies and car companies can use is the critical step, is the biggest bottleneck and the biggest hurdle for these markets. So for us, we're going to need a lot more of all four of those minerals. Of course, we get asked the question copper as well a lot. Absolutely, copper is going to be a big winner from the energy storage revolution, but for us, it lacks that speciality step. The supply chains are already in place to make the copper that these guys buy, whereas for the four that I mentioned, the supply chains aren't in place, and they're not at scale, even now, for what the high-quality battery producers need.
So what's your pick?
All four.
All four. Okay, very diplomatic.
Whatever you can get a deal in, I guess.
Got it. All right, Anthony?
Yeah, I think the question needs to be asked a little bit differently, and I don't think it reflects the reality of investors. And so I think you really have to say, are you asking, can a $20 billion hedge fund, how can they make money in it, or how can a retail guy investing $1,000 make money? And the reason why it's different is because of liquidity. And the capital markets are completely different today than they were 20 years ago, and they're completely different today than they were 10 years ago. And today we see fund flows are passive. We see a lack of hedge funds in the space and really specialist funds altogether. And so it's a long-winded way of saying, if you are a huge pool of capital, you probably need to play copper. You probably need to play First Quantum, and you probably need to deploy $100 million that you can liquidate in 5 trading periods because your documents say that. And in 2030, by the way, 15% of copper demand will probably be related to electrification. If you are investing $1 million, well, look at cobalt. It's at $15 today. The entire cobalt market is probably 130,000 metric tons. And in 2025, if there's 15 to 20% EV penetration, that market is going to need to be 250,000 metric tons, with 100% of that cobalt going into the EV market. And I think lithium is kind of at the midpoint in that spectrum. And so, when I look at the space, I think it is a very important thing for investors to consider that these are specialty metals, and liquidity matters in a world where capital markets are dynamic and changing. And so, what do I think are the two most interesting? And it's self-serving. I think, nickel off of a base of 15, cobalt off of a base of 15. You're going to see, mid-20s again this year. And I think, the sleeper in all of this is really nickel. Think about the conversations. And I don't know if you recall, but over the last few years, the number of times that Simon and everyone up here had to answer the conversation, oh, what about the new battery technology? What about the new chemistry? Well, guess what, guys? Every single automaker in the world, save it for Tesla, has chosen the nickel, manganese, cobalt formulation, and Tesla chose the nickel, cobalt, alumina formulation. Now, in 10 years, things might be different. But today, as those chemistries evolve, and they have already been adopted, and by the way, if a new battery manifests itself here today, it's not going to see the inside of a GM car for 6 years. As those chemistries develop, they develop towards a nickel-rich chemistry. And so for my money, if I talk about this year and making money, nickel, how do you do that? Well, you can buy in Norilsk, you can buy in Independence, you can buy Western areas, or you can go way down. If you're a retail guy, you can buy a Giga with the largest nickel sulfide deposit. So that's how I play it. But I think when you're asking that question, you really have to consider that the capital markets today look completely different, and that really impacts your ability to make money, and you have to consider that.
Got it. Ted, you'll have a different perspective.
Yeah, I'll probably be even more diplomatic than Simon on this one. But to your point about where you can get a deal, we believe that we need to be producing electric vehicles profitably in the next 4 years, and all of the regulations in China where we sell a vast majority of a big portion of our overall fleet. That's going to push us to this 20% sales figure in China by 2025. So you got to think about sort of time ranges there. We've done a development deal on batteries with Honda, so you can see a little bit more detail in terms of that co-development and the battery modules that Honda will buy off of us to try to get to this sort of scale where we can do this profitably. So, you know, you've got the smart gentleman to my right who can kind of talk to you about specifics. I'm trying to give you the sort of parameters of where the gutters are for this.
Can I just add
Yeah,
one
sure,
more
go
thing?
ahead, Sam.
I can rank the four in order if that helps in terms of profile and interest we get from the industry. We don't invest, by the way. We can't. We're completely independent. But from an industry investor supply side, you have lithium as number 1, nickel as number 2, cobalt as number 3, and graphite number 4, where we stand today. From a battery and automaker perspective, their worries are nickel's number 1, graphite anodes number 2, lithium's number 3, and cobalt's number 4. So that gives you some perspective.
All right, is everybody clear? All right.
The first one was industry, supply side, so mining guys, chemical companies, investors that we deal with around the world. But the actual guys that are using these materials have a completely different perspective right now. And that's just different investment cycles in capacity.
And just to add to that, the thing for a mining audience needs to understand, and Simon already said it, it's not about lithium and nickel and cobalt. It's lithium hydroxide demand and supply, lithium carbonate supply and demand, cobalt sulfate, nickel sulfate. Because nickel's it's fascinating because when you actually see what's available to mine it versus sulfide outlook versus laterites, there's a real problem brewing. Maybe it's 18 months away, or who knows the timing. But in order to make the numbers that the nickel sulfate and where you're getting that is a very complex issue about where you're going to source it and what's going to be moved from what's going to go into metal production versus chemicals production, and what's going to offset what from the supply side. But it's very complex, and it'll take. I mean, maybe you can say more about it.
And I think one of the points here for investors is that nuance allows for promoters to sell fake stories, right? And they're not all fake. There's a lot of great stories. But, you know, you come in and you have a graphite guy. Let me tell you how many, Simon, how many different types of graphite are there, right? And by the way, with nickel, there's a very nuanced story around class 1 nickel and nickel pig iron and what the crossover prices are. And so I think you have disruption sometimes, or dislocation maybe is the right way to put it, inside of the capital markets with different public equities, because invariably it takes a while for the education process to happen with the investors and for investors to sift through the stories and actually understand, okay, well, there's lithium and there's hard rock and there's brines, and like, what is the cost of processing and how, and that's taken a while, I think, for investors to understand. And it also has caused dislocation in valuations across all these metals, I think. And I'm talking about the equities as opposed to the underlying physical, which are two separate and completely independent markets by and large.
Okay, let's shift gears and talk about what is really driving this, at least in terms of what's up front in the news media, and that would be the electrical vehicles. And we can use Tesla as a proxy, really, but certainly they're not the only one. Far from it. In fact, I think they're really
China's the proxy, not Tesla.
I was going to say, well, they're a proxy in the media, but yes, you're right. China is far and away bigger than Tesla. And Ted mentioned profitability, which people sort of give Tesla a hard time in the news, and I suspect GM has the hard time. And then you layer on top of that subsidies. So, where are we? And I think in order for this to become the S-curve growth that everybody talks about, we need cost parity. How close are we? We hear all sorts of different estimates. Maybe I'll ask Ted to take a kick at that first.
Yeah, so I don't think you would have seen the announcements that you would have seen, that you saw from us at the auto show. We put Cadillac out as our electric vehicle vanguard last month at the Detroit Auto Show because we believe that parity is coming. We believe that our partnerships are getting us there and giving us a market advantage. Part of what's driving all of this is certainly the combination of customers' demand for longer range vehicles, which Tesla has provided to a certain bit, but we've been able to compete more on that, $35,000 mass North American price point at least. And then, the charge time, understanding, how fast am I going to be able to charge the car on my trip and reducing the anxiety around that. So those are the sort of, where we're sort of matching kind of these changing customer segments, and Anthony had it bang on. The year-over-year change in terms of growth in EVs has been the thing to watch, as opposed to the overall market share. I think I saw the figure was like 81% in 2018. So that's what we're watching carefully. And you may have seen, part of our hiring and our shifting in terms of where our attentions are being paid. Many more people working on not just EV, but the autonomous vehicles, which are all battery electric vehicles. And we believe fundamentally that many more of the kilometers or miles traveled will be EV miles. So, thinking a little bit about heavy usage of these vehicles might weigh into how you're thinking about this industry overall.
Do you have any idea how much, apples to apples, one GM with an internal combustion, one GM with a EV motor, how much more does it cost on a percentage basis today?
Yeah, I'm gonna punt that one down the line.
Fair enough.
Also, I think, first of all, it's very close now. But second of all, if you think about the tragedy of the commons and costs not being priced in, we're also talking about an awareness which is growing inside of society that, we have had an impact on climate, whether that's how that climate change has exactly been impacted, and we're seeing a social awareness. And what I find fascinating in this conversation, and it's often missed in the press, is that probably for the only time I'm aware of, China is taking a lead in global public policy, in global environmental policy. I will tell you right now, in my view, China is the leader in the world in environmental policy right now as it pertains to electrification. And so this ultimately means that, if you're sitting in Canada or the US, you need to sit back and think about what is the future of your automobile industry going to look like when China is putting tens of billions of dollars into this, and they are going to create the automobiles, they're going to have the battery technology, and you are going to be driving a Chinese electric vehicle in the next decade if somebody in Canada doesn't start producing them, or in the United States. And we've seen a dramatic decrease in the cost of these vehicles even in the last 12 months. And I think it's very close now on a like-for-like basis. We're talking within hundreds of dollars in many cases. In fact, in China today, you can buy a $5,000 electric vehicle. Now, mind you, the battery is small and it can only go short distances, but it's here. And when you look at disruptive technology, what are the disruptive aspects that prohibit the S-curve? One of them is cost. That's gone. And then the second one is usually around utility. And utility in the case of electric vehicles is distance. Well, guess what? An electric vehicle fully charged already goes further than 99% of people travel in a day in the West. And second, recharging time. Well, you're dropping that down to about 20 minutes, 20, 30 minutes. Now, guess what? When I show up with my 3 kids at the 7-Eleven, I can't get out of there by the time they use the bathroom in 20 minutes. And so those barriers have fallen now. You're seeing that adoption upswing massively, even quarter on quarter. You're seeing China aggressively go into the market and say that they are going to produce these vehicles, and you're seeing them buy them in China. And by the way, in the US as well, by the way, in November, 10% of all new car sales in California were electric. So it's happening, and it's probably there.
But maybe GM is the best example of the tipping point being reached, because when GM decides that they stop producing the Volt, it's a very, very clear sign that within North America, we've taken the decision that it's going to be battery electric vehicle. Let go about the hybrid. I think that's the good sign of the adoption, and that they realize what the market wants.
It's not just EVs, by the way. You also have to understand, the EV is like story 1, exhibit 1A. The even bigger story is the knock-on impact of electrification and grid storage and batteries, and the way that all of a sudden renewable energies economics are completely transformed by the potential of a vanadium redox battery or even lead acid batteries. And so this is really a decade to 20-year long complete revolution in energy. And we're talking about EVs, and that's the first step because it's happening and we can all see it happening. But actually, these batteries and this technology, not just lithium ion, but some other technologies as well, are also completely changing renewable energy and the grid as well.
And I should add in, one of the things that many people don't see is the number of electric miles traveled by their Uber and Lyft drivers. So We are one of the biggest suppliers of EVs to Uber drivers in California. We have something like 40 million EV miles traveled since we launched our Maven Gig program for these drivers. So, keep on thinking about that as percentage of total miles traveled, especially as these cities get denser and denser.
Now, and you're raising an interesting point. The question is not complete when you ask the parity between the ICE car versus the electric vehicle car. It's not the purchase price that should be considered. It's the cost per mile that you're, and the cost of usage of this car. When you make the analysis, somebody that goes over 30,000 kilometers a year is paying less per kilometer if he has an electric vehicle, even he paid 20% more.
I used to cover auto parts, and it's interesting that industry. When you look at why people buy cars, it's fascinating because they don't do total cost of ownership. We'd all be driving Camrys or whatever like 10 years ago, and we weren't. It's a fashion item. People want to belong to a club, and they buy what they think. What is the old thing? Your house says who you are, and your car says what you want to be, something like that. So the interesting thing is you don't make rational decisions. You'll spend $1,200 for a TV screen on the back of your headrest. I mean, it doesn't make any, there's no cost benefit analysis to that, right? But you do it anyway. So what's interesting is you're buying, the trends are about something else, not just saving money. And it could be about the feeling better about yourself, belonging to a club. It could be a bunch of things, but clearly the cost getting close enough has enough people making that transition. I think that's the important thing. The thing I want to bring up, and it's related to a couple of the comments, when you look at the long term, the 2025 or 2030 outlook, I don't think anyone would really deny that there's a transition's happening. Then you look at the stocks and you say, so why aren't the stocks doing well? I don't get the disconnect. The problem is you'll see things like a huge amount of the demand being in China. You'll see China normal auto sales roll over. And what a fund manager does is they don't look at the EV sales increasing 70, 80% year over year. They look at what's happening economically in China, and they say, I don't care, I agree, Mac, your EV outlook looks fantastic for 2025. I need to make money this year, maybe next year. So what do I buy this year? And so they look at the China economy, and they say, well, that just doesn't look good. Like the EVs could go down, even though the normal sales are going down and EVs are up year over year. I don't know what's going to happen. So there's a disconnect over what an investment manager or portfolio manager does this year based on data like that versus the long-term trend, which I think we all agree, and most people agree, like I'll probably be driving an electric vehicle in X number of years. But how that translates into an investment decision in guys that run money, it doesn't translate. They're still short-term focused.
They get paid annually, right? You get paid 2 and 20, and if you're going to get your 20 in 2019, and you think nickel or cobalt is happening in 2020 January, well, guess what? We're buying it on the first of the year, and that's actually really important because it's back to the structural change in the capital markets. It really is impacting mining stocks, even mining stocks which are unrelated to this. Some of the big M&A, I think it's impacting the whole sector, that reorganization of capital markets, and it certainly is impacting the equities in the battery metal space with the perception of a rollout over multiple years.
Yeah. I think that more fundamentally this kind of ICE vehicle versus electric vehicle comparison, I think we're only going to be talking about it for 2 years, really, because we're going through a trend in the lithium-ion battery industry of costs coming down significantly, quicker than even like we would anticipate. And of course, the battery cost is the fundamental key input to an EV. So this year, Tesla will produce a lithium-ion battery regularly for under $100 per kilowatt hour. We predict that's going to be $95 to $97 per kilowatt hour. That's a massive decrease where we were even 2 years ago. Now, I think as soon as the top tier of battery producers in the world, and this would be Panasonic, Tesla, Samsung SDI, LG Chem, then the big ones in the tier 2, CATL, Li Shen, BYD, but it's integrated, so it's different. When those guys can produce batteries at the same cost level that Tesla is, then the whole thing changes. Quality, this is why I mentioned tier 1, tier 2. It's not just about them getting batteries in. It's similar to the raw material situation. Quality, under 100, and I think we're probably, for all of those to reach that lower level, we're probably only about 2 years away from that.
2 years away. Well, that's good to hear. And I just want to point out one thing, and Anthony raised it. It's important to note that different batteries have different uses, obviously. We're talking mostly about cars, right? And then you mentioned vanadium redox, which is a sort of a different thing, and probably I would say we're not quite as close as on a cost comparison, but maybe you can correct me.
No, I think, look, when you look at any commodity, whether it's tin foil in the early 1900s, whether it's your, gold, well, pick a commodity. And, what will happen is you'll have a commodity which is by and large in equilibrium, meaning supply and demand with growth factored in kind of add up. And what you see in this space is a tremendous new demand coming that none of us can predict the exact moment it's going to hit. But when it does hit, and when it hits in full force, and it feels like it's unfolding as we speak, you will have an overreaction, an irrational overreaction in these commodity prices that will incentivize new production, and ultimately there will be a new norm that will be higher than today in these commodities, right? Like it's a classic commodities curve. And we're going to see it here. I don't know when. None of us know when. And as an investor, if you're able to accurately predict that and be long when it happens, you'll make huge amounts of money if you're along the right stocks, which is, why you get paid the big bucks. But that's definitely coming. I think that's one of the messages is it's coming. Timing it is pretty tough.
Okay, let's talk about, I want to narrow in on the EV batteries, and I'm going to throw it to Simon because I know he's got a lot to say on the build-out of the factories. Provide a little context on that, and then everybody else can jump in when they want.
Yeah, it's funny, we call it the rise of the battery mega factories. It sounds dramatic, but for the last 3.5 years 4 years since Tesla announced the Gigafactory, that was the first battery mega factory in the pipeline. Today, we have 71 in the pipeline, of which over half are based in China. Now, you can argue, we had the question, well, most of these aren't on stream. Actually, about 45 of the 71 were producing last year at multi-gigawatt hour capacities. And you can see the stresses in the supply chain for the raw materials as well. So this, first it was Tesla that sparked it. Then China took over and started building, planning large expansions. When I say China, you've got the Korean and Japanese majors building big plants in China. And more recently, we've seen Europe announce a number of big battery plants as well. So this is a global phenomenon. And it's what really is driving the confidence for the car manufacturers. This is actually driving a lot of their big EV numbers in the millions of unit vehicles a year by the mid-2020s, because they're going to have the confidence now that the batteries are going to be there. But the question is, do the battery producers have the confidence that the raw materials are going to be there?
Well, definitively, I was going to warn our GM friend here, because usually a OEM car manufacturer thinks that the raw material is like a supply chain. You can click, and within 6 months, they can increase, double, triple the capacity. So they rely on a battery manufacturer that then turns around, and there's no raw material. We were talking about your prediction of volumes yesterday, and no way, absolutely no way, the supply chain can fulfill the expected demand, because it takes 10 years to come from a zero to a mine and qualify the product so that the OEM car manufacturer can give a warranty of 5, 6, 10 years to its battery. So I think that the car manufacturers are going to face a big, big wall very shortly, because the mass adoption is there, the demand is there, the car manufacturers won't have the batteries to put in.
I disagree. I slightly disagree, respectfully. Like, go back and look, and guess what? There's always every trade has a clearing price, okay? And I think what you see is a massive incentive. We saw this iron ore, right? You'll see the price of lithium will go from X to YZ, and then whatever the next ones are, right? So the price response will be overwhelming for all of these. And then a wave of response will happen over the course of time. And so I don't think, and I think it's a disservice to say, well, we're not going to have enough cobalt, or we're not going to have enough nickel. No, there will be enough cobalt, there will be enough nickel, there will be enough lithium at a price. And I think that the price might be substantially higher. Like, I don't know what that price is going to be to clear the trade, but it will be there because it's always there. When you look at the last 100 years of commodities, the commodity will manifest itself at a certain price. At a certain price, you'll be digging it out of the sand in Namibia or something, like,
But,
I think it'll be there.
Very respectfully, there's a difference between highly specialized chemicals versus commodities. And the problem that we see now, and just take the example of lithium. In 2009, 2010, when I started in that business, 85% of the world's supply was coming from Argentina. 4 years later, they had about 50%. Not because they lowered their production, because they could not increase their production. They lost all of this to the Chinese. Now, they were already built, already qualified, but there was no big rush for, let's say, lithium hydroxide of battery grade. So the difference between increasing or being able to put new production because of a price acceptable for new production to come online is not linked to have a qualified product to put in a battery. That's the big difference between the trend that we usually see in the commodities and this year. The best example, there's tons of new spodumene concentrate coming out of Australia. Does not find his way in batteries. It finds his way in new production capacity being built in China that don't produce at the rhythm or at the run of capacity they have. And when they do produce, it's low, cheap, technical grade. So it does not serve the market it's supposed to go. And the price, while the three big suppliers, when they lost 35 points of market share, the price went to $20,000. So they should have been able to catch up. They were controlling the world. No, they lost that because they were not able to expand. New regulation, technical issues, qualification issues. So I say again, and I stick to my point.
Taking the last cycle nickel, like the Chinese came up with a new technology on nickel pig iron, completely blew out the nickel market, right, for a decade. So with lithium, by way of example, and the technology is not there. What about the guys spending hundreds and hundreds of millions of dollars to do the brine-less, the extraction, no evaporite pond? I'm not telling you that that's going to be there tomorrow. I'm just saying that I think we shouldn't tell people there's not going to be natural resources because historically speaking, the price gets to this point and somebody, the smartest guy or gal in the room, figures it out. And so it's to say that we will have enough resources. They're going to cost more, so it doesn't change being bullish for the equities, but there's going to be enough. That's my view. You have a different view.
That's why I'm bullish on the price of lithium, because there will be enough. There will not be enough of good quality, so the producers of good quality are going to be recognized by the market. I'm just warning the OEM car manufacturer not to treat the raw material as a usual normal supply chain that you call and
Absolutely,
you can
yeah,
have
I
like
agree.
this material.
And China, this is why what China is doing is so spectacular. It's genius, and why they're going to lead this, they're already leading it, is because they are going around the world, whether it's Ganfeng in South America, whether it's Australia, whether it's Molycorp in the Congo. They're going out there, they are securing the supply chain. It's going straight back to China, and they're going to lead the world on this thing simply because of the foresight and the capital to do it. And so, if you're GM, I do think you need to be worried because guess what? Like, if 75% of cobalt comes out of the DRC, and by the way, more than half of that is controlled by China Moly alone, well, like, that makes life tricky. And I think that's one of the points.
And I'll step in the middle of the fight between Guy and Anthony.
It's not a fight.
Well, it's a respectful fight. This is good. I like it. Yeah. But you're both right. It's a timing issue. That's what it's down to. I mean, if you think of how long it takes to build a battery plant, 18 to 24 months. How long does it take to build a mine? 5 to 10 years. How long?
7 to 10.
7 to 10 years. What? Okay. All goes well? 5? No. 7. Okay. 7 to 10 years. How long does it take to build
a new mine versus expansion, right?
I'm not talking about expansion. How long does it take to build an electric vehicle from scratch,
4.5.
including all the research and planning and all of that?
So there's lots of dependencies in there. But just to sort of build upon the point about being ready for this, I mean, we saw this in the rubber industry. We've been partnering with Michelin, thinking about responsible sourcing of rubber and understanding this in that sector. So, it's a point well taken, but it's not our first rodeo in this. And so I think, it's important that we're part of these conversations.
Well, Henry Ford, I guess, was sort of famous for buying a rubber plantation, right? So why isn't? I mean, China's
Ford
doing-
also bought palladium at the top too, didn't it?
Well, they don't always make the best decisions, but, the point is they recognize there is a supply issue, whether, it hits price equilibrium or not. To secure the raw materials, I think is important, and Anthony, you said China's doing that, and I think they are getting ahead of the curve. But why aren't the big three, or just, I don't want to pick on the big three, why aren't end users being more aggressive in the West, being more aggressive in buying, the resources at source? Why aren't we seeing that?
Sorry. I'll answer that and just follow on. It's interesting when you look at what the majors, if you look at the last reporting, they talk about 15 to 20%, maybe a little higher, depending on who you look at, in terms of growth in lithium demand year over year. And then you look at what their sales, what their guidance is. So SQM, what's their guidance in sales this year? Increased 0. Albemarle, maybe 10,000, in terms of volume, 10,000 tons, maybe it's 30,000, we can argue, whatever. When you look at Livent, it's 0, Orocobre, 0, Galaxy a little bit. Like, if you do 15 to 20% of what was last year, they've got half of what's coming online. So yes, spodumene, produce oodles of spodumene price, we can start to see it drop. But we don't see, what do you think is going to happen to lithium carbonate and hydroxide prices in a situation where, by their own admission, the major producers are expecting 20% growth and they're preparing for 0? Like, that's their guidance to analysts. That's a disconnect. But again,
There's
that's
also a cost of
just,
capital issue, right? Like,
Yes, yeah.
China. What's your cost of capital? Like, your bonds are 10%. What are they? I don't know. My
Yeah.
cost of capital. In other words, China. I don't know
most
what's
15.
GM's cost of capital. So China Inc. can just say, "We're going to go buy this mine. Thus saith the Lord," and like there it is. You guys have a cost of capital, and we have a WACC, and you have a WACC, and so, if you're taking a 10 or 20-year view at the state level, well, maybe you give a 2% loan, or maybe you make it an MPV of 0 or an IRR of 0. You can play with it differently, whereas GM and everyone else sitting up here is playing by market-driven forces, whereas I think it's a policy-driven force in China, and so their access to the cost of capital is completely different than maybe what mine is or what.
No,
GM's
I
is.
think you're right. I mean, I think they don't really work on an NPV. China thinks on a 100-year basis, and we're constrained by NPVs and IRRs, which have terminal values which don't get captured beyond 15, 20 years. I mean, it's nothing. So I think we're at a major disadvantage. It is policy, but actually, it's really just longer-term thinking.
But also, when we talk to automobile makers, like what they tell us is, and while some of them have made statements that they're looking at mines, and I think that's true, like, that's not their business, right? Their business is actually making automobiles. And so, you invest in a mining company, and before you know it, the wall collapses or there's a cost overrun, and now you're explaining to the board why you put $2 billion into name your mining company, and that's a difficult conversation to have. And so maybe some of these companies have to re-envision like the supply chain, but that's not happened yet, and I think it's a big risk. And you're a mid-level guy at GM. Guess what? You don't get paid to take risk. Like if you buy cobalt and it goes to $30 from 15, like you don't get 20% of the upside on that. But if you buy cobalt at 15, it goes to 5. Guess what? You get fired. So the risk incentives inside of these companies are slightly different, and so it's going to have to be this board-level decision globally, these automakers to say, like, okay, the world has changed, there's a new mousetrap, and in order for us to compete globally, we're going to integrate. And people are getting there, but they're not quite there, at least outside of China.
How can they compete with, they're judged quarterly, if not daily, based on their share price, whereas China, doesn't play by those games. How can we compete? So, let's talk about China. How do we compete with somebody who plays by different rules?
First of all, I'm glad China's doing it. I think this is one of the greatest things that could happen for the Earth today. Like, we are damaging the Earth, and it needs to change, and at least somebody's doing something about it. Heaven knows, like, America's not. So this is great that China is sitting there and putting up their hand and saying, we're going to change the world. So I don't think this is a bad thing, but on a corporate level, it's tough. I don't know what the answer is. If you're GM, I don't know what your WACC is, but maybe the answer is you can't compete, and 20 years down the road, the Detroit of the future, the Silicon Valley's electric vehicles, is sitting in Shenzhen. Like, maybe that's a reality.
But if you talk about China, it's determination of the rest of the world. If we do not have the determination to keep a chain of supply outside of China, it's simply that we have abandoned and that we decide that we close Detroit, we close everything, and we buy everything, and we're service clients. and we don't build anything else. Because today, what's happening in China, I think it's 52% of the supply currently controlled by the Chinese. But the Chinese also started to take control of SQM, an initial foot in the step by 23% that they bought. And they're doing that with commodities around the world. Not because they want to export at the end of the day, I'm talking strictly about lithium here. Not because at the end of the day they want to sell and export lithium hydroxide to Korea and Japan, to their competitors making cathode or batteries. Because they will be able to tell LG, tell Samsung, if you want to have lithium hydroxide, you must consume in China. So you're going to be building your plant in China. That's how they will control the world of electrification. That's how they're going to control the world. And if we don't act as countries, as companies, that's exactly where we're going. They add 15% less, 15%, 2010 of the supply. They're now at 52%, and it's growing.
I think it's interesting, but if you look at Volkswagen, of course, they suffer through this Dieselgate scandal. The CEO gets replaced by the guy that was the head of the research, who was focused on EVs and batteries and other things as well. And then what do? They go and they tell analysts, tell the public markets, look, our net income percentage of revenue, our net income margin is going to be half for the next 15 to 20 years. That's what they're doing. They risk the valuation of their stock by saying we have to invest so many billions of dollars that we have to cut our net income margin in half to do that, to plow money back in. So that's what their response is. If you look at then how they go and do that, they market, because remember they're marketing machines, they talk about the EV, but when you look at the product introductions and what they're betting on is that they're hybrids. Which is still fine for all these commodities and the chemicals that need to be made. There's lots of demand coming. But that's the reason for that is because of their constraint. They have to still make money, and they have to make enough margin to reinvest it, and by model by model by model, shift what their offerings are in a profitable way. But it is costing them. And fortunately, what's interesting is that their valuation don't suffer as much as you would think, given the fact that they've had these compressed margins, or the outlook is for compressed margins, because the growth potential that they'll get market share because of that strategic shift is what's driving valuations, or at least supporting them.
So China's sort of notorious for controlling, if not manipulating, commodity prices. We saw it with iron ore. We've seen it with graphite. What else have we seen? I mean, it sounds like, just speaking to you guys, they control, or at least buy, a lot of the lithium. I mean, are they liable to, if the price gets too high, flood the market, play that game? Is that a situation?
Not in the lithium space. Not in the lithium space. If you compare to the rare earth, where they could, where they could do that in the rare earth, because they're producers, they have the raw material. It's not the same thing with the lithium. They are importing from Australia mainly the raw material. So the cost structure for them, having to pay taxes to get out of Australia, pay profit in Australia, then transport. The larger portion of the cost of making a ton of hydroxide or carbonate is the raw material, and they cannot cheat on this one. So even if they were subsidizing 100% of the transformation, they would still be at a cost of about the brains. So they don't have that flexibility in the lithium space.
And you have to look at where the resources are dispersed around the world. I mean, China does not have big deposits of lithium, good quality deposits at all. Doesn't have cobalt. So what have they done in the last 10 years is invest outside of their country and invest in the supply chains to make that into the quality needed, the battery grade needed. And that's something that the US, for example, or North America as a whole, has not done.
What about cobalt? They control a lot. I mean, Chinese are big in Africa. Obviously, everybody knows cobalt 65% comes to the DRC. Do they control? How much power do they have on the cobalt price, the Chinese?
Even my observation is that even in relatively liquid commodity prices, ultimately the free market dictates the price, although in the short term there's volatility. So cobalt went to $44. Today it's at around kind of 16, 17. That's really a function of artisanal mining in the DRC. $30 is kind of where artisanal mining happens in the DRC. You saw the price shoot through $30, go all the way up to 44, and so you have a kind of a reverse triangle. As you pass $30 on your way to whatever the number was, more and more and more of this artisanal material came in. That has created a temporary overhang on the market. And what you're going to see even later this year is the cobalt price will move back up into the mid-20s, have a cap, or excuse me, have a ceiling, a temporary ceiling of around 30 until the big demand hits kind of 18 to 24 months out, and then you're going to see it move up again. So none of that had anything to do with the Chinese master scheme. That had to do with market forces around artisanal production. It had to do with the difference between an intermediate product and a metal price. But I don't see, and we know intimately the largest traders in the world and producers, I don't see on any level any price manipulation by the Chinese government in cobalt. I just don't see that.
Okay. Let's talk, Mac, I'd like your input. How are you? You're in the investment banker. You're sort of, I guess, an outlier on this panel. How are your clients, the institutions, how are they approaching it? What sort of risk profile are they willing to take? How do they want to get exposure to this? And what are you advising them on?
I've sort of touched on a bunch of that already in the course of the comments, but right now they're nowhere. They don't want to touch any of these. And I think I was looking at my comp table before stepping up here, and it's interesting when they will watch, they agree with, they see the macro, they understand the demand. That's not in question. What's in question is what to do this year. So they're very short-term focused. And you got to keep in mind that there's more opportunity than there is, there's more opportunity than there is money. So money moves around. And we have a technical quant analyst very good at doing his job, and he tracks how that money moves. And right now, it's not moving in to this sector. And what I think you need to see is the majors start to see their valuations improve or go higher. So what people are looking at, rightly or wrongly, is spot prices, because you can get those prices literally every day. They're irrelevant, but it's what everyone looks at. So I have to comment on them, even though, and always have an asterisk beside it saying, look, they don't matter, but I know you're looking at them. So the issue is this year, I think we're going to see the market get tighter again, as we've talked about. Pricing will, on the spot market, depending on what you're looking at, will rise. The majors, meanwhile, will be living through a year in which their production and sales aren't really going higher, yet the demand just kind of keeps going higher and higher, and so the market gets tighter. So if we see that tightness come back, then I think valuations of the majors will improve. And what typically happens is the guys that are early take their money and they take their profits and they recycle it by going into the next set of companies. And we've seen this in every commodity. They'll invest in the new entrants. And then when they make money there, they'll invest in the developers. And that cycle happened in 2007, 2008. It happened in 16, 17. And I think we're going to see it sooner than later. I think we're getting into a period where we have tight markets and less tight markets, but we do not have oversupply markets. They're tight, less tight, tight, less tight, and the stocks are going to be very volatile. So it's going to be a roller coaster ride probably for 10 years. But that, I mean, it gives me a job for a while, right? But the issue is it was hard last year, really hard. I know people personally that have made investments and have lost their job.
Well, let's do a real life example. Cobalt 27, okay? That's me. Imagine the phone calls I've had. My share price is at $13.50, and it's at $4.50 today. Why is that? It's very simple. The price of cobalt was $44, and it's $15 today. But you better believe if the price of cobalt is at $60, my share price is going to be, I can't project it or whatever, get in trouble. But you know what I mean? It's going to be whatever it is. And by the way, same with Guy. You had a slight cost overrun. Your share price is getting smashed. Like both of our share prices have been smashed. However, if you could see through the next 30 minutes, the next month, if you could see through that, there's going to be this moment where not just Cobalt 27, not just Nemaska, but this whole sector moves materially higher, and investors are going to make a huge amount of money. It's just a function of duration. Do you have the duration? And it's going to be bumpy. But if you believe what we're telling you, if you believe the numbers, it's inevitably going to happen. It just may take some time, or by the way, it may be in 6 months.
Yeah, I feel like Ted's going to need a really big drink after this, because basically what's happened, what you've just said essentially is can the industry and the supply chain rely on the public markets to fund the build-out of the supply chain for electric cars and energy storage? And the answer is a resounding no. Most of lithium has funded itself. And that's the big problem for people like GM, for people like Tesla. And the big question they have to ask themselves now is, do we get involved? Because they've waited and waited and waited for the last 4 years. They know what these plans are going to be. Okay, it's been a bit more aggressive the last 18 months. But what we're talking about, we've been talking about for a long, long time. And I think no longer can the car companies just rely on people in this room to get it done, because they're not.
So just, we're wrapping up here. We've got a few more minutes. We'll take some Q&A. But a couple more questions. What does the car industry look like in 5, 10 years? Are the big three still the big three? Or are we going to get a China group come in here? I mean, see eyebrows raising there. What do you think?
I was thinking of something earlier when we were talking, and I can be a devil's advocate for why the automakers perhaps haven't moved like you think they should move. And the obvious answer would be because they don't believe it. So let's suppose they, and I mean they, the Western automakers, are allowing a lead to develop because they think the Chinese are going to blow their brains out on it, that it can't be done. And again, I'm not saying this is what I agree with. I'm just throwing it out there. So these are sophisticated companies that understand distribution, supply chain, manufacturing. They're very sophisticated, filled by very intelligent people. And if you read, anything about disruptive technology and how companies evolve because of that, it's very important to understand that, to see these companies as being rational. So on the one hand, they're pitching a vision of the future. And on the other hand, running their business, like how they run their business is telling you how they really think. So if they're not, the argument goes, if they're not contracting or building or investing, it's because ultimately they don't think it's happening. So the challenge is, if they're wrong, they will lose.
But
Now, on the flip side, I would never count against American and German car companies in terms of they're seeing exactly what's going on. And that could be completely wrong. But I think it's wrong to think that these companies are managed by stupid people. They're not. And there's been countless examples in the disk drive business, in the steam shovel business, in the lots of examples where well-meaning, intelligent, well-run companies have been disrupted out of existence. But equally, there's many that have survived because it's all about timing. Because if you do it too soon, they'll be in trouble. So, so just to answer your question directly, I think the majors survive, and I think they thrive. But I think there's a bunch of new entrants and they lose market share.
You're going to be driving Beijing Auto Mark cars, guys.
Yeah.
Unless something changes, it's that simple. It's not going to be called Beijing Auto. Beijing Auto is the parent company. You're going to be driving whatever it is, and it's going to be a subsidiary of a Chinese company unless the world starts to change quickly.
More than 50% of the cars are in China. So the balance, you cannot ignore the zero emission laws that are adopted worldwide by different countries. So a car company today that is not already in modification with electric vehicle is going to die, disappear.
So Ted, you said this is not your first rodeo, rather, and I think that's a fair statement. Which says you guys are a bunch of smart guys, but you got a serious situation. What's your perspective?
Well, I came into this industry 2.5 years ago after being a management consultant for 20 years, and I confessed that why you're recruiting me, I don't know what a carburetor is, and they said it's okay, we don't use carburetors anymore. They had hired me in part because I wrote a book called The Uber of Everything, which was about all of these regulated industries being disrupted. And our job today is really to take that moment that we had in 2008, 2009 and say we were at the precipice, and that unless you've had that moment of knowing that you must fundamentally change your business, how you staff, how you think about the future, and focus on the customer, you just don't exist. And so, I do agree with the point of like, watch what we do, not just what we say.
Okay, well, literally, I have loads of questions here, but the conversation's flowed really well, but I think we are wrapping it up here, so I want to open it up to the floor, and I'm sure there's lots of questions for these very smart gentlemen, so Rand's going to run around with the microphone.
Hi, guys. Thanks for a great panel. This question's kind of, I think, for Simon, Ted, and Mac. How do the three of you guys incorporate mobility as a service into your medium and long-term demand forecasts?
So maybe I'll start. So again, you'll see in our last Investor Day one of the charts that we had that looked at our total addressable market in the trillions of miles available. Not just looking at what the market share of Uber and Lyft is or predicted to be, but also how much of the personally driven miles that you can imagine cannibalizing, especially where there's lots of congestions in cities. Anybody, Anthony and I were talking about before this, like how much productivity do we really have on a 90-minute commute, from Oakville or wherever into the city, and what would we want to change? We still think that our trucks and performance cars are going to sell really well in suburban rural areas, but we think that there is much more going to be happening as mobility as a service. We've introduced an all-new electric pedal assist bicycle to try to address some of this. I'm a believer in the sort of subscription services that are coming about, and you'll see many more partnerships struck across the OEMs trying to figure out that combination of active transportation, public transit, car, and how that fits into your lifestyle.
The short answer is I don't. I'd go bottom up, just looking at what the car makers are saying they're going to do and launch, because over the time frame of investment, that's all that's really going to happen. Long term, I think what we're facing is something that's going to be transformative, like a smartphone. And what it'll mean is a whole different business model where, it could be vehicles are given for free, or because you're willing to pay. I'm willing to pay more to be in a vehicle on my own to work because I will have a confidential call to make. My nanny's going to do it with 4 other Filipino ladies that she lives near, and she's going to pay a lot less, or get it for free. And I'm going to subsidize it because I'm going to pay more. Like those business models we haven't even really dreamed up, or they are being dreamed up, but that will transform really transportation, which is why I've sort of said I wouldn't count out the West, because I think whether it's Amazon or Apple or in conjunction with GM or Volkswagen, whomever, the distribution they have and the ability they have to pivot and could be phenomenal. But from a 2 or 3 year or 5 year outlook, I can't predict. I just don't know how to do that. So I have to go bottom up and then throw it all out the window when it becomes apparent that these things are catching on, just like we've seen, the autopilot sort of that Tesla has take hold. Clearly something changes, and then you see it adopted very rapidly. So I think one day we'll wake up and over the course of 18 months, something will happen just like the smartphone.
Yeah, I think it's a really good question, Emily. Basically, no one does, I don't think, because it's such a new phenomenon in the industry. You have to take the cue from the car manufacturers, listen to what they're saying, and then try and map it in. I think the most important thing about forecasts, at the moment, everyone's just mapping out pure demand and drawing a line and saying, you're going to have 1 to 1.2 million tons of lithium by 2025. Well, that's never going to happen because you're not going to be able to have the lithium. The supply chain won't be in place. So what we try and do is map where the bottlenecks will be. Okay, there's going to be enough spodumene, but will there be enough conversion capacity? There's going to be enough brine extraction. Will there be enough battery-grade chemical capacity? Will there be enough lithium-ion batteries? Will there be a cobalt shortage? Will there be, and so all of these things will slow down these massive forecasts.
Another question out there, sir.
Yep. So thanks for the panel. It's very good. Question, we understand that a battery system within an automobile, its lifespan is less than the actual chassis onto which it's attached. So we have people that will be in the future, changing the battery system perhaps in the vehicle. And the question is, will the recyclability of these components, is there specific commodities within them that will be depressed over the long term because they are highly recyclable? Yeah, the circular economy part of it, and is that something that there's forecasts associated with?
The first, the first recycling of a car battery is energy storage. So it's going to last another 10, 15 years because it's not as demanding as the car. Yes, there is currently some assessment. I think in some of the outlook of the supply, I think 5% is looked at being coming back from the recycling. There's a lot of work being done around the world on the circular economy on this. Currently, nobody seems to be recovering the lithium. It's easier with the actual method to only get the metals back, not the lithium. At Nemaska, we're working on certain technologies and development to be able to recover everything in the battery, but you're still years away from having a commercial. First, there's not enough volume yet, and the batteries, if you took the Tesla, it's 8-year unlimited mileage of warranty. So in 2022, you're going to start to see about 822. You're going to start to see some of the batteries, but very little. They were producing less than 100,000 a car a year. But at some point, you will start to see these. But before that, energy storage.
Yeah, it's a really good question. What's being recovered from batteries now in small scale and test facilities? Lithium is being recovered in small amounts, but can you use it in a battery? No. Nickel can be recovered, copper can be recovered, cobalt can be recovered. But the question is, can you use graphite anode could technically be recovered? Can you then use these materials in what's going to be by far the biggest market, which is batteries? Right now, for most of them, no. And it's being able to reprocess that into a battery-grade material. That's what's really going to impact the market. Otherwise, they'll have to be used in other applications.
But the answer is, if you go around the world, I mean, I'm aware of probably 20 different groups spending a huge amount of money on it. Like, you know, this nut will be cracked for sure. It's just going to take some time. But by the way, we have time, as Guy pointed out. You know, the second life of these batteries is significant, and it will become an important part of the ecosystem. I'm confident in that. And the technology is getting close, but I think the supply for it to be relevant, in particular for the EVs that are on the road today, is still a ways out. So I would say that people working on that, the problem is addressed, and I think it's going to solve itself over time with the money being spent.
Okay, there's another question out there. Rand, where are you? Yeah.
Thank you very much to the panel. Very good. I have a kind of a side question. What do you think that the major oil and gas companies should do, or how should they adapt to this electrical revolution?
It's interesting you asked this question. I was participating in the, I think it's Deutsche Bank Electrification Day, but specifically for their oil and gas clients. And I attended the presentation of a couple of oil companies. One in particular was very interesting, Shell. If I was coming from outside and I didn't know that Shell was an oil company, after the 45 minutes of presentation, I would not have known. Because what they were selling is their location, prime location, their good quality of coffee, the Wi-Fi, free Wi-Fi in their location. And that's why, because they made their market assessment, they say, somebody that stops at my store with an electric vehicle is in average spending $8.26 more than the ICE vehicle owner. That's why we organize nice couch, free Wi-Fi, good coffee, donuts, because these people, that's what they want. That's why Shell at that point said and confirmed, we're going to install 10 supercharging or fast charger at each location because we want to capture these. Maybe they will be only used 20% of the time at the beginning, but people are going to stop at our prime location because what we're selling to them is coffee.
Slightly different view. LSC Lithium was purchased by a smaller oil company, or it's in the. I read about it. I'm not involved, but I read that it's an oil company is buying LSC Lithium. One data point: if you go to the FT Commodities Summit annually in Europe, all the oil companies are there, and it's all they're talking about. But you've yet to see Shell buy Albemarle, or I think something like that probably is inevitable through the cycle. I'm not saying those two companies, but that's probably in the pipeline eventually.
Yeah, that's a good point. Make no mistake, big oil is watching these supply chains very closely for a couple of years now. When an oil major comes into this space, they'll just go big. And that is something that eventually will happen. It's just a question of timescale.
And Mac made a great point, though. Like, if you go back to the 70s when the big uranium thing happened in America, a bunch of steel companies and random kind of companies went into uranium, and then they lost their shirts. So, maybe the philosophy is like we're going to wait a little bit and then pay up when we believe it's happening.
I think they actually have a lot of growth, like they have decades. If you penetrate the EVs and you look at use year over year, oil demand is growing. The economy grows. It takes a long time, even at 100% sales of EVs, to turn the fleet over. So demand for oil continues, not like it used to. So they have decades to figure it out, whether it's the customer-facing business, whether it's like Total and other companies getting into solar. Like you gotta supply power, right? So maybe they go further upstream and say we need to diversify the sources of energy, but we're energy companies and we distribute when we source energy. That might be, I would imagine some companies go that route. Other companies go face the customer and try to get the touch point with the customer. But clearly that their model will change, but it's going to take a long time to get there. The other thing is that natural gas is a feedstock for lots of materials. In fact, if you think about it, we burn all these materials, which are organic materials that were basically created by sunlight eons ago. We take it and we burn it to move around. It's gone. It makes way more sense to take that and use it to make plastics or to make stuff that has a longer life and more utility. So I think what happens is you don't run out of the demand for certain types of petrochemicals. We just use them a lot. They get more valuable because they're more valuable for other things than to burn, so we can move around. It's kind of ridiculous. I think our children's children may look back and go, what were you doing? Like it is a little crazy when you can make something hard and durable with that material rather than burning it to move.
And the other thing we didn't even talk about today, we don't have time, is ESG, right? Like, there's a lot of funds now which are not allowed to allocate to managers who invest in coal and cannot themselves invest in coal. And whole different conversation, but like what's going to happen over time with the oil industry, and how does that happen? So there's a lot of things there, a lot of moving parts.
Okay, final question, then we're all out of here. Go ahead, sir.
I was going to say there's a lot of lithium in the world, and I've been looking at it for 60 years myself. So, but I will say this: that the lithium industry is in the sort of Yukon gold rush stage. The big mining companies haven't really shown up, and it's like the big auto companies; they'll eventually get in there too. But until you have the sort of mega companies start to say, "Gee, this lithium, why are we, not paying more attention to it?" and so on. I think, and when I look at the analysts who look at lithium, one thing I see is they look upon it as they look upon gold. Like you could take gold out of any rock. Lithium, you get an assay, but if it's lepidolite, that's a completely different thing. And it's
So you could have been our sixth panelist here. What's your question?
Well, my question is that I think maybe Guy was a little too pessimistic about the supply side. It will take some time to get through, but don't you think that until the big mining industry, the big guys, start to say, gee, this lithium, maybe we should be looking at it, do you think this is one of the things that might hold up? Because a lot of the people are underfinanced, they're spread out, they got a little pile of stuff here and there that they're picking away at, but they're not going in there with the kind of might they require to push this whole thing together.
You don't see Barrick developing 10,000-ounce gold deposits, until the size, scale of the development of the projects is sufficiently large to be more interesting than their copper projects. Like, you're not going to see that. You're going to continue to see Nemaska's, Galaxies of the world developing these deposits, and then fast forward 5, 10, whatever, then you can see the consolidation. But if the projects aren't there, and there's competition for capital between that and copper in the majors, like copper's going to win. It's not realistic to think that they're going to take some little tiny
think
lithium
it's-
project over Grasberg. It's not
Yeah.
going to happen.
Yeah. No, I think volume-wise, we will never be able to attract money because I think that your question was about how do we get finance into this thing. I don't believe it's going to come from any major. I think at the end of the day, everybody sees this still as an industrial mineral. So most of the money is going to come, I think, from end users, mostly, instead of big companies.
I agree. No matter how big the demand for lithium comes, and the demand for nickel's even bigger, right? So it's too small. It's just small. We've seen. I've been on many site visits with lots of representatives from those big mining companies, and they all kind of just sort of shrug their shoulders and go, "I can't kind of pitch that. Like, it doesn't move the needle."
What do you mean, a 50-ton truck? I'm used to 450 ton.
Yeah.
So, are you joking here?
Yeah.
And actually, there's the point. There's lithium. You got the brine resources. That's a liquid resource. That makes sense for oil companies. They understand moving and drilling out liquids in a sense. But the opportunity for big mining companies is in Western Australia. All of those Western Australian companies could be consolidated, but all of them, it's a slightly different process, slightly different deposit. There's nuances to what they process and what is sold to the market. So that will be the biggest challenge for the big miners.
Okay, well, let's leave it there. I thank you all for coming. I want everybody to give a round of applause for these gentlemen up here. Appreciate everything. And enjoy the rest of your time at the PDAC. Thanks again.
Thank you.